Hello and welcome to 5-Year Club video number 310. Tonight I thought about doing an article on today's stock market drop, but you can only do so many videos on stock market volatility before it's boring, right? Because it's like, yes, sometimes the stock market is volatile. It's true. But instead, I thought I would cover something a little bit different, which is the difference between knowing something theoretically and living through it emotionally, right? And so I'll start off just by giving you a concept, all right? And this concept is that in a buy and hold investing strategy, let's just say dollar cost averaging, right? So what that means is that every paycheck, every month, you are investing the same amount in the stock market no matter what the stock market is doing. If the stock market's going up, you're buying more of it. If the stock market is going down, you're buying more of it. Obviously, if it's going down, you will be able to afford more shares this month than you could afford last month because those shares are cheaper because their price declined. Similarly, if the stock market is going up, you will be able to afford fewer shares this month than you could last month because the price has risen per share. And in theory, your income hasn't changed all that much. Your savings rate hasn't changed all that much from month to month. I hope it has. I hope it's gone up, but maybe not, So, all right. So let's imagine now a scenario where the stock market is falling. And let's just say you have $100,000 in the market, invested in the market, to make the numbers easy. Let's say that this is a very dramatic stock market fall, not too different from 2008, 2009. So at the end of 1 year, $100,000 has turned into $50,000. Right? So you're $50,000 down. That seems unpleasant, right? But let's say at the time that happens, right, that you are putting money into the stock market, right? And now I haven't modeled this out. So obviously if the stock market is falling and you're putting money into the stock market, then the first money that you invest will have less paper value at the end of that 12 months because it will have declined over the next 11 months or 10 months or whatever it is. But just roughly speaking, right? If you invest, I don't even know what it's supposed to be, like $75,000, $50,000 into the stock market in that year, then at the end of the year, you have $100,000, right? Like in theory, let's say, every month, the stock market is falling by some amount, and the amount that you contribute to your portfolio as part of your savings is roughly equal to the decline in your portfolio, right? And so the market is falling, but your portfolio balance is remaining even. Okay, so on the one hand, that doesn't feel very good, right? On the other hand, in theory that this situation isn't sustainable. This can't last forever. The market can't keep falling. I mean, I guess it could, right? Like if aliens came and started blowing up the planet or there was a nuclear war, I guess it's possible that the stock market would go below 50%. But if we look at the last 100 years of history, if we look at the last 200 years of history, we don't see sustained periods where the stock market drops in half and stays there for a really long time. What we see is a dramatic fall to 50%, and then over the following 2 years or 5 years, we see it come back to its previous value, and then we see it go beyond its previous value. Because generally speaking, these setbacks are temporary, these debt crises are temporary. We're able to resolve them and do things to work around them. And the advance of technology, the advance of productivity, these things move us forward. They create wealth, and that creation of wealth is reflected in the total value of the stock market. So in this scenario, right, like if the stock market falls faster than you can buy shares, if the stock market falls faster than you can save money, that doesn't feel very good. But you know in theory that historically it can't stay down there. And so if it falls super fast, let's say one day it drops in 50%. Well, that just means that it's likely to rise over the following 2 years. And so that money that you're saving over the next 2 years is likely to go up. You're likely to make money on that investment. And so if you are very early in your investment career, you should be hoping for such a fall. I mean, maybe not for ethical reasons, because people will suffer from it, but in terms of your net worth after 40 years, you should be hoping that early in your investment period, the stock market has a huge sale, a Black Friday sale. I think they actually called it Black Tuesday. And you should be hoping that it falls so that with that early career money that has a huge time value, you can buy these shares very cheaply. And so you should feel really good when the stock market falls. But it turns out that's not the way that it feels when it's actually happening. So, if you've been paying attention, October was a really bad month for the stock market. November hasn't been great. It's been pretty volatile. And I have not really been able to substantially outpace those drops in my savings. And so I just wanted to show you like what it looks like for me. We have the top graph is my savings behavior in the last 90 days. So that's in aggregate all the money that I've saved in the last 90 days. I get paid tomorrow, so if I included tomorrow, it would tick this graph up a little bit, and it would tick this graph up a little bit. But as of today, right now, this is what the data is. This is what it looks like. And I'm not going to give the numbers, but only 11% of the money that I have saved is reflected in my net worth. For this 90-day time period right here, I am barely up. I'm just barely above zero. It would not surprise me if tomorrow I'm below zero. If the market just falls a little bit. And yet I have plowed well over half of my earnings into savings. And I've got nothing to show for it in this investment net worth over 90 days. And for me, that's like, oh, come on. It feels like you're treading water. It feels like nothing's happening. I know in theory that I purchased some cheaper shares in the last 90 days because the market fell, and that's a good thing. I know in theory that despite whatever the net worth number says, I know that I have more shares of profitable, productive companies than I had 90 days ago. And I know in the long run that, this isn't how the graph is going to look. I know that there is good historical evidence that in the long run, this is just a small blip. It's not going to matter. The stocks are on sale, and they're going to continue to rise. But in the short term, it doesn't feel very good. In the short term, the reaction is not stocks are on sale. The reaction is the market is falling. Maybe I should hold off on putting my money in because I don't know if it's just going to keep falling. I don't want to be the sucker, right, where the market falls by 10%, I put in my money, then it falls by 30%. That would suck. But see, this is exactly the mindset that gets people into trouble, is the fear mindset when the market falls. Because what ends up happening is you don't put in your money, you wait, and then after things have already risen back, that's when you put in your money because you're like, yeah, we're on the way up. And then you've missed out on participating in a lot of that upward gain after the drop. And when we look at the models, we find that it's very difficult to come up with criteria for drops that indicates a buy or a sell. We find that over long periods of time, most of those strategies are indistinguishable or not that much better than simply buying at regular intervals, no matter what the market volatility is. And so I will continue just buying the market like I have been. But I recognize that this past 90 days looks really crappy. And it doesn't feel good. And so if you're looking at your portfolio, your situation, and it's something similar, I'm with you. We're in the same place. On the plus side, we can continue building on this savings and make that go up, and history indicates that we're going to win in the long run. On the minus side, the stock market volatility, funny money doesn't look very good right now. So, boo-hoo, I almost wish there was like a S&P 500 Black Friday sale ad. That would be funny. All right, well, this is the reality of being an investor. This is the reality of saving for retirement. And so, yeah, it's good just to know that, like, this is a real situation that you could be in, and it's fine. It's going to work out just fine. Again, if the market fell and I was completely negative for the last 90 days because I'm still relatively young, in the long run, that would help me. That would be good. It doesn't feel that way, but that is what is logically true. So, yeah, there we go. All right, well, I think that is it for video number 310. Hope you enjoyed it. And it might be interesting for you to see what this graph looks like for yourself. I think there's going to be some really interesting interest rate stuff that goes on in the next, 3 months or 6 months. And I'm trying to figure out an angle on studying that and covering that is not either boring or so macroeconomic that it's irrelevant, or both. In particular, kind of the way that interest rates impact mortgages, adjustable rate mortgages. I was looking for that earlier today. Because, Dave Ramsey says it all the time. I've said it before. When you go for a mortgage, if you get an adjustable rate mortgage, especially if you got one in the last 5 years, interest rates have only one way to go. They've only had up to go. And so how is your adjustable rate mortgage going to adjust once that 5-year period ends? Of course, it can only go up. It's not going to get better. And now we are seeing the Fed raise interest rates. That's going to put more pressure on home buyers that opted for an adjustable rate mortgage. If the economy goes south, is that going to push those people into default? I don't know. I think that the Fed can't kind of like, they can't pump up interest rates by 5 or 10%. That'll just totally kill the economy and kill the market. So they wouldn't do that. But I understand why they don't want to do nothing. Because if they do nothing, then if a crisis happens, then they will have no interest rate to adjust, and no way to stimulate the economy. All right, well, that is it for number 310. Have a fabulous evening.